Hello, everyone, and welcome to KBRA Podcast. I'm John Sage, Senior Director and Head of Private Credit Research here at KBRA. Today, I'm joined by two of my colleagues, Ken Egan from our Sovereign team and Karim Nassif from Corporate Infrastructure and Project Finance. In this episode, we're diving into a really interesting topic, how inflation in Europe has become less correlated with oil price volatility. We'll unpack why this link is weakening, from reduced oil dependency and greater supply diversification across the EU to stronger policy buffers and market fundamentals taking center stage. Then we'll explore what this all means for Europe and the credit backdrop for businesses in general. For anyone who wants to take a deeper dive, our discussion draws from two of our recent reports titled Oil and Inflation: Implications for European Corporates, published on October 20th, and Oil's Diminishing Role in Euro Area Inflation and Sovereign Credit Risk, published on October 1st. You can find both reports on our website at kbra.com. Now let's dig in. The reports highlight several macroeconomic and political factors influencing EU inflation. So Ken, let's start with you. Can you elaborate on what your research has shown about inflation's sensitivity to oil price shocks in Europe?
Sure. Our regression analysis really reinforces the themes we laid out in our report. It shows that inflation in the euro area has become much less sensitive to oil price shocks over time. So using monthly data from 2003 through year to date 2025, we found that the on-impact effect of crude oil on HICP has steadily declined from around 20 basis points in the noughties to just about 12 basis points today. And this aligns with findings from the IMF, which point to factors like fiscal interventions, regulated energy tariffs, and the shift in crisis dynamics from oil to the gas as key reasons why oil's pass-through to inflation has weakened. Structural changes have also played a big role, from diversified supply sources and efficiency gains to tax policies that help smooth out volatility. Compared to the US and many emerging markets, where fuel costs and subsidies have a larger impact on inflation, this reduced sensitivity is actually a credit strength for the euro area. Now, even though first round effects have diminished, we still do see delayed impacts through contracts and second round effects that keep energy embedded in pricing. And while the trend points to oil shocks having less punch, there's still risk that major supply disruption, like extended shipping blockages or coordinated OPEC cuts, could trigger renewed inflation pressures. From a sovereign credit perspective, oil shocks now tend to cause smaller, less destabilizing inflation episodes, meaning less chance of abrupt fiscal and monetary reactions. Since late 2022, we've also seen a partial decoupling between oil prices and inflation expectations. This reflects both the growing role of renewables and a shift in inflation drivers towards services. Importantly, inflation expectations themselves have become less sensitive to oil, a sign that market participants and policymakers are increasingly anchored.
Really appreciate that color, Ken. How is the energy transition and electrification reducing oil's influence on inflation?
The energy transition is playing a huge part here. Europe is steadily moving away from oil and toward cleaner energy sources, which naturally limits oil's influence on prices. According to Eurostat, the direct renewables and biofuels share of final consumption was around 12% in 2023, up from roughly 6% in 2003. But if you look at the broader measure, the share of renewables in gross final energy consumption, it's now nearly 25%, the highest ever recorded. That difference is important. One metric captures the direct renewable fuel use, while the other reflects the full role of renewables in the overall energy mix. Electrification is at the heart of this shift, More transport and industrial activity is being powered by electricity instead of oil. In fact, the IEA projects that the EU's electricity capacity growth between 2023 and 2028 will be among the fastest in the world outside of China and ahead of the US, India, and Latin America. All of this points to structurally lower oil dependence, which helps explain why oil price shocks now have less immediate influence on euro area inflation. And that's why it's a positive trend for sovereign credit.
Thanks, Ken. Now, drawing from that analysis, I'll pivot to you, Karim. What impacts have these forces had on European energy companies?
That's a great question. For a long time, I'd say volatility in oil prices has been a challenge for European energy companies. It's been affecting their margins, investment activity, and overall demand. When oil prices have risen, margins can look strong. But when they fall, you often see the opposite for these energy companies: weaker margins, reduced investment, and operating leverage working against companies with high fixed costs. Looking ahead, we think energy companies will remain moderately exposed to oil price swings, but the overall importance of oil as a driver of their financial health is fading. Now, there are several reasons for this. The first is that Europe's energy market is diversifying. It's shifting towards cleaner fuels, away from oil, towards, for example, natural gas and renewables. That's why the recent softness in oil prices hasn't had the same impact on the sector as it might have had in the past. Second, bond spreads tell an important story. The energy company spreads have stayed tight, often narrower than the broader corporate market through 2025, despite subsiding of oil prices. Third, geopolitical risks are still present, but fundamental market forces are now playing a bigger role in setting oil prices. Despite ongoing tensions in places like the Middle East and shipping disruptions, the average annual oil price has actually softened over the last few years. OPEC still has ample spare capacity, about 4.6 million barrels a day, and recently began unwinding voluntary cuts. With production growth expected to outpace demand through 2026, we see oil prices likely to remain under supply pressure in the near term at least, barring major geopolitical events or major supply disruptions.
Understood, Karim. But taking even a broader view, how do you think the European corporate sector and these trends will play out there?
So looking at the broader corporate space in Europe, as oil becomes less central to Europe's inflation story, which Ken has been talking about, a wide range of industries, from manufacturing and chemicals to transport and logistics, are set to gain. More stable energy prices will mean better planning, steadier costs, and more confidence for businesses. If oil prices fall further, that could even lift cash flows for many companies, especially those with high energy input costs. Now, this trend also makes the overall macroeconomic environment more resilient and less vulnerable to inflation spikes or rapid interest rate hikes, all positive factors for the European corporate environment. That said, energy importers and producers still face exposure, particularly to natural gas, which remains a key transitional fuel. Gas prices, if they spike, can still squeeze margins for unhedged companies. And the decoupling between gas and oil prices means we can't just assume that gas will be as stable as oil or will align with oil prices. A few factors structurally are driving this decoupling between oil and gas. Most European gas contracts are no longer oil indexed. Oil and gas now serve very different end users. Gas markets remain regional and infrastructure dependent, unlike oil's globally traded network. And finally, EU climate policies treat gas and oil differently. Gas is viewed as a bridge fuel, while oil gets less policy support under carbon frameworks. So looking ahead, gas prices will be important in understanding the commodity exposure broadly of European corporates. And gas prices will depend on factors like European storage levels, Asian competition, supply-demand dynamics, and the ongoing energy and digital transitions.
Appreciate that breakdown, Karim. All said, I'd be interested to hear your big takeaway from the research that you've been working on recently.
So to summarize, what I'd say is overall, the weakening link between oil and inflation is a broadly positive development for energy-dependent European corporates. Many energy producers also are actively reducing exposure to oil by redirecting capital towards renewables. That said, exposure to natural gas remains significant and will continue to shape Europe's energy transition story.
Now, Ken, same to you. From your perspective, any concluding points from your research?
From a sovereign perspective, oil is still an important risk channel, but its immediate inflationary impact has clearly softened. As expectations stabilise and renewables gain ground, oil shocks are creating smaller, less frequent inflation episodes. Of course, governments still face fiscal costs when shielding households from volatility, so while this shift supports greater resilience, it is gradual and far from absolute.
With the energy landscape evolving so rapidly, we hope today's conversation gave you some useful insights into how oil dynamics are influencing broader sovereign and corporate credit outlooks across Europe. Have a question or topic you'd like us to cover? Feel free to reach out to Ken, Karim, or myself. And don't forget to rate, share, like, and subscribe to the podcast. Invite your colleagues to join the conversation too. I'm John Sage, on behalf of all of us here at KBRA. Thanks for listening. Take care.